Good day, ladies and gentlemen, and welcome to the National Directors Institute Checkpoint Web Conference Series. At this time, all participants are on listen-only mode. If anyone requires assistance during the call, please press star then 0 on your touch-tone telephone. As a reminder, this conference call is being recorded. I would now like to turn the conference over to your host, Ms. Jessie Lockman. Ma'am, you may begin.
Thank you. Welcome, everybody, to today's conference. I would like to welcome you to our fourth session of our 2010-2011 National Directors Institute Web Conference Series. This is our 10th annual NDI, which we began in 2002. As in NDIs in years past, we are looking forward to sharing the insights and experiences on corporate governance issues that we think matter most to you. The goals and objectives of our NDI have always been to provide practical insights and useful takeaways to directors, executives, and boardroom advisors. If you missed our prior 3 NDI webinars earlier this fall, which covered the topics of proxy access, say-on-pay, and ISS's 7 main corporate governance issues for 2011, the PowerPoint presentations and audio for those sessions are available on our dedicated NDI website, which is at foley.com/NDI. Future NDI webinar sessions can be found on our NDI website as well. And of course, we recently held our in-person NDI in Chicago on January 12th, and program materials for that session are posted to our NDI website. Our next in-person NDI will be held on November 17th, 2011, so please watch for details to come. We'd also like to take this opportunity to thank all of our NDI co-sponsors, many of whom have been supportive to NDI for years. AN Corporation, Deloitte & Touche, D.F. King & Company, Eversheds LLP, FD International, UBS Investment Bank, Vintage Filings LLC. We'd also like to thank our in-kind sponsors, Boardroom Bound Corporate Secretary, NASDAQ, and NYSE Euronext. Today, our program is entitled The D&O Insurance Market and Liability Trends. Leading today's session will be my partners here at Foley, Ethan Lenz and John Landis. Joining Ethan and John will be Jackie Urban, Senior Vice President, Legal and Claims Practice at Aon Risk Services, and Maria Fazzolari, Senior Claims Manager at Freedom Specialty and Nationwide Company. Before beginning our discussion, a few housekeeping items. Our conference today will last approximately 1 hour. During this time, you may submit questions via the Q&A tab, which is located on your menu bar at the top of your screen. We will try to answer questions at the end of the program, but if we run out of time, we will follow up with you individually after the conference. We encourage you to maximize today's PowerPoint to full screen by hitting F5 on your keyboard or from the toolbar menu, selecting View and clicking Full Screen. If you would like to print or save a copy of today's PowerPoint presentation, you can do so by selecting the printer icon at the bottom right-hand corner of the screen. Foley and Lardner will apply for CLE credit for you after the conference. If you did not supply your CLE information when you registered, please email it to Elizabeth Harris at eharris, Harris, at foley.com. You must log in to both the audio and video portions of this session to obtain CLE credit. And now I have the pleasure of introducing John Landis to lead us through a discussion of D&O liability trends and the current market for D&O insurance. John?
Thank you, Jesse. Good afternoon, everybody. I'm John Landis. I'm a partner in Foley's Chicago office, and allow me to begin by thanking all of you for joining us today. I know you're busy, and if you're having as nice a day as we are here in Chicago, really appreciate you staying inside and being with us. A special thanks to Jackie and Maria and Maria's colleague Marty Schnabel, who had hoped to be with us today but couldn't, and also to Ethan for all of their time and their effort and their willingness to share their experience and their expertise. This particular subject has been a staple of the National Directors Institute for many years, and I'm confident you'll refine the insights that Jackie, Maria, and Ethan have to offer to be illuminating and helpful. And if we could go to the next slide, that'd be great. My job is to sort of lead things off. Our presentation is broken down into 3 sections. And we're going to focus really on the second and third parts of the presentation. I'm just going to take a few minutes to go over very briefly some updates on D&O litigation and enforcement matters. Jackie and Maria will then provide a D&O market overview, which is really the guts of our show. They'll focus on pricing, capacity, and claims, and then we'll transition into a discussion led by Ethan of developments in some coverage terms. We should be, about less than an hour. May have times for some Q&A, but all of us are available afterwards, and I encourage you to contact Jackie, Maria, or Ethan. So if we could go to the next slide, that'd be great. Let me begin by briefly discussing some litigation and enforcement developments that are relevant, I think, to the D&O insurance market. I would describe the last year as a little bit less tumultuous than previous years, which, maybe not saying much given the credit crisis that we've all been going through. But there are some things that are kind of bubbling under the surface that are relevant. So if we could go to the next slide. Here's what I'd consider to be some of the highlights of the past year, things that are maybe relevant to insurers and to insurance brokers. Depending on which analysis you look at, and there are a number out there, there seemed to have been a small increase of securities class actions, and there's been a notable increase in fiduciary duty or derivative shareholder litigation. Again, depends what you're looking at. There's a lot of those, analyses out there, but this seems to sort of be the consensus overview. On the enforcement front, the SEC has formed these specialized units, and in my opinion, that really is going to signal the likely direction of enforcement in the coming years. That's where the SEC has decided it's going to place its resources, both in terms of manpower and money. So it just makes sense that that's where they're going to focus. The big legislation, of course, the last year was the Dodd-Frank Act. Tough to say at this stage how that will impact private litigation or enforcement proceedings. There are some obvious provisions that may have an impact. It will be interesting to see what, if anything, the result is there. Economic conditions are obviously driving suits against private company officers and directors, customers who haven't been paid or haven't gotten what they've bargained for. Employees who have been let go, and now that the economy is starting to pick up a little bit, mergers and acquisitions may be a ripe area driving suits there. Next slide, please. This is just a historical record of securities class action cases over the last 15 years. It's sort of the logical place to start because it may impact terms of D&O insurance. This is courtesy of the Stanford Law School and Jackie and her colleagues at Aon. As you can see, lower right-hand corner there between 2009, 2010, a very slight increase, pretty flat, especially compared to like 2008. Next slide, please. In terms of where these cases are being resolved, I guess you could safely say that activity has been fairly flat as well. We had 8 cases in 2009 that settled over $100 million, 6 in 2010. There's a slight increase in the median settlement from $8.5 million to $10 million. Again, many thanks to Jackie and her colleagues at Aon, as well as Risk Metrics Group for this information. If we could go to the next slide. Here's my observations in the area of class actions. Again, a bit of a reduced pace of suits relating to the credit crises, although those are not done. There was a bump in the number of suits at the year end, and my research, it looks like many of those cases are M&A disclosure cases, and obviously that would correspond somewhat to the increase in M&A activity that's starting to pick up. The target industries, same as always, financial institutions, information technology, healthcare and life sciences, and, well, I guess for-profit education isn't always on the list, but it has been recently. A few Supreme Court cases of interest. The Merck case having to do with when a statute of limitations for securities actions begins to run. The Morrison case involving the application of our securities laws to actions involving securities traded on non-U.S. exchanges. And then 2 cases that are pending before the Supreme Court. This Halliburton case, which talks about proving loss causation at the time of class certification, and the Matrix case, which talks about or addresses statistical significance when addressing the materiality portion of a securities claim. So keep an eye on those 2 cases. Next slide, please. Going forward, as the economy picks up and M&A increases, I think that's probably where we're going to see continued suits. Ellie, could you forward the slide? And then, the Dodd-Frank case, the Dodd-Frank Act, pardon me, and the whistleblower provisions of Dodd-Frank, not clear what that's going to portend for securities class action cases. The protections to whistleblowers may prompt more situations that actually lead to the filing of suit, but it's just not clear yet. In terms of fiduciary duty and derivative litigation, as I said, there seemed to be a notable increase in these kinds of suits. I mean, the hurdles have gotten so high for pure fraud actions that plaintiffs' lawyers are looking for other ways to make hay, and there's been an increase in the number of suits filed in federal and state courts. M&A objection suits based on acquisitions, going private, management buyouts, proxy violations, and this really ought to be a point of concern for any public or private company that's starting to get active on the transactional side. Next slide, please. In terms of enforcement, let me shift to that for a bit. We had a lot of very high-profile proceedings: Goldman Sachs, Citigroup, Bank of America, Rorich, the insider trading case that the SEC lost. And then we had the first non-prosecution agreement matter involving Carter's at the end of the year. The SEC was willing to enter into a non-prosecution agreement. From my perspective, the best way to always sort of see where the SEC is headed is to listen to what they're saying, and at the recent SEC Speaks session, the following points, if you look at a summary of what was discussed, were raised and I think emphasized. Staff is going to continue to emphasize its cooperation initiatives with companies, areas of enforcement focus and investigative focus, insider trading and Foreign Corrupt Practices Act, and that leads into this national specialized units topic. You can see the areas on the PowerPoint here where the SEC has created these specialized units. It would, I think, be safe to say that this is where the SEC is going to really focus, because the SEC has been very candid in discussing its budgetary constraints. The Dodd-Frank Act creates all these new responsibilities for the SEC, and there's some question as to how they're going to carry all those things out. If you go to the next page, here's just a quick summary of those acts and portions of the act which implicate the SEC, and it'll be interesting to see how they tackle those. Last point on this slide, I think that we will continue to see robust cooperation between the SEC and the Department of Justice, and I think that makes particular sense given the SEC's budgetary challenges. Last slide, next one. In terms of litigation involving private companies, this is always a bit of a challenge to summarize and analyze. In my research, there seems to be a modest decrease of actions against officers and directors of private companies. The only data that's out there is kind of sketchy, but back in 2006, Chubb did a survey of private companies, and its survey in 2006 indicated that 26% of respondents had been involved in the D&O suit in the preceding 5 years, and the most recent Chubb survey indicated that 12% had. So there seems to be a decrease. However, to the extent private companies are going to get active in M&A, that's probably fertile territory for suits against officers and directors, as is companies that are doing business with the government. I think the government is going to continue to take a very close look at contracts and is not going to hesitate to pull the trigger on investigations and actions that include officers and directors. So that's a very, very brief summary of the prior 12 months in the private litigation and enforcement areas. Let me now hand things off to Jackie and to Maria for a bit of a market overview. Jackie?
Yeah, sure. Thanks, John. What I'm going to do is talk a little bit about what's happening in the D&O market in terms of pricing, capacity, and a little bit on the claims function. Let me see if I can make my slides do what it's supposed to do. And is that great? So this is a summary of the things that we want to talk about. It's really still a soft market for most insureds. There are a few individualized differences and some industry differences that will make a little bit of a difference, and depending on the claims history of an individual insured account, there may be some differentiation in the pricing, but overall it's still a soft market. It's a function of market capacity and some of the claims activity, which we'll go into in a little bit. I'm going to talk a little bit about what we see clients purchasing, what kinds of coverage, limits, et cetera. I'll talk a little bit about whether a relationship with a carrier matters, whether creating that relationship on a D&O product matters, which I think it does because it's really a customized product. It's not an off-the-shelf product, and because the market is so soft, I think the relationship matters probably more than ever, and especially is important on the claim side of this as well. And then I will address a few of the coverage enhancements that we have seen over the last 12 to 18 months, which addresses some kinds of coverage available for individual directors and officers that wasn't previously available in the marketplace. So that's some of the pre-claim inquiry cost covers that are offered now, and what we call the personal protection suite for some of the individual risks, individual disgorgement, extradition, even some defamation protection for individuals only, and a new product that has just been released for entity coverage for SEC investigations, which is actually very new to the market, and some insureds I know have been wishing for some kind of product like this, so we'll talk a little bit about that, as well as general improvements to terms and conditions that have been available. Now, on the macro side, the market update, with respect to capacity, we would say that we think it's stable and significant capacity available. It's over $1 billion in theoretical capacity that's available in the marketplace. Now, no one insured has a program that is that large, but there are markets that offer layers totally met in the marketplace, so there's quite a bit available, and that drives pricing quite a bit. We think that the majority of the markets that are accessed for these lines of business maintain AM Best ratings of A or better. Most of the insured solvency fears from late 2008 have subsided. I know there are some recent developments with Chartis, and we watch those regularly, and they're still A-rated at this point. So we continue to watch the developments with all the carriers as far as their financial capacity and capabilities. With respect to the actual coverage terms and conditions, they really remain willing to provide lots of improvements if they're requested. They won't necessarily offer them to you directly without saying anything, so make sure that if there are things that are of interest to you and you find would be helpful to you, that you inquire about those and make a request. The primary terms and conditions that we see are very broad, probably broader than they've ever been in the D&O world, and they're very heavily manuscripted. So what you see on the base form that is provided to you is probably not what you have to live with, and a lot of changes can be made and have been made and are easily granted by most carriers. The form that Chartis launched last year was called its Executive Edge D&O form, and that is the product that includes a lot of these personal protections, the pre-claim inquiry costs for individuals, where it's not required that there be a formal investigation, or it's not required that an individual be a target, but they will cover and provide coverage for individuals subject to a retention still, but for retaining an attorney, responding to the SEC or other agency or enforcement body. And the competitors, as you might imagine, to Chartis promptly released endorsements that might also provide similar coverages. So that's available on a wide basis if it's something of interest to you. I think for some carriers they need it to be premium bearing, so it's a consideration, but it's something that should be investigated and evaluated if this is something that would be of interest to you. Just a week or so ago, Chartis launched what it calls its Investigation Edge form. That's a separate standalone cover, and it provides entity coverage for SEC investigations. And that obviously is a separate program. It's not tied into the D&O, so it's meant to have a separate retention, and it's meant to be priced separately. So we will see how that goes as far as Chartis' ability to sell that if people are interested in purchasing that product at the price it's going to be offered, and whether the competitors offer something similar in that. And I would say stay tuned for those types of things. On coverage, again, excess layers we also see are vastly improved. We've gotten a lot of improvement on the terms and conditions in those layers to make them more true solid form coverage than perhaps their off-the-shelf product might be. With respect to limits, because the pricing, excess pricing especially, is very thin, we see some of those carriers trying to expand their participation on programs in order to capture more premium, and that's especially true for the A-side marketplace and the A-side layers. So that's a place where you can get a lot of participation if it's something that you would like to do is increase capacity in that space. There's a lot of availability and good pricing. The retentions, though, we think are pretty much stable for most of the insureds. We don't really see a great change in the retention that most of our insureds are willing to take. And we also find that just taking a higher retention does not necessarily mean that you save on the price. It's not a dollar for dollar savings or even a good percent in the savings. So at some point it is not necessarily worth it to take a higher retention to save on cost. As far as pricing, I'll show you our index in a moment, but it's really generally below what we'd call our baseline year 2000 levels, despite the increased frequency in claims and the increased severity on some of the securities claims. I know that many markets feel the severity can be underwritten too, though I've talked to at least one excess underwriter recently who believes that the severity does matter, and that is something that is going to impact a lot of the excess players at some time coming in the future, because they've gotten on risks recently, and with the average settlements increasing, it is likely that, and defense costs actually, which was not, I think, in the graphic, defense costs might eat up a lot of a primary layer on a very significant claim, and so that you're reaching into the excess layers to complete and resolve your cases, so it will impact the excess layers. Primary pricing, though, is very competitive for most insureds, and there's a lot of interest by the carriers in obtaining that primary position, especially because the excess pricing is very thin and much more competitive than the primary. There's a lot of participants competing for those spots on programs. And we continue to anticipate that environment is going to last through this quarter, which is almost at the end, probably a little bit longer into the year as well. But one thing we do say is the industry and the individual results do matter and can have a wide variety in the pricing that you get. So one of the things that as an insured you want to do is make sure you work at and differentiate your company from your competitors or others in the industry that might be facing some issues, so you can show that your risk is really worthy of that excellent pricing. And the next slide here is our D&O pricing index. Now this is through Q3. I'll give you the number for Q4, even though I didn't get it into the slide in time. And how we base this is off the 2001 base year. We count that as a 1.0. And so we look at how the pricing of purchasers from each quarter has gone year over year from quarter 1 2009 to quarter 1 2010, for example, are the comparison points. And you can see that using 2001 as a base year, there was a spike in the hard market in 2002-03, and then it's come down steadily since that time. And just last quarter, it really dipped below the 1 baseline for the first time, and the Q4 2010 number is 0.98. And so it's still below 1. Now, there's always an uptick in our fourth quarter numbers for the most part because a lot of the financial institutions renew in that fourth quarter, and their pricing, not surprisingly, is higher, and that will influence the average. But if you look at the trend line, it is still down. I don't know how much lower it can go. The carriers would like to say that it's at the bottom and it's going to turn, but they've said that for a while, and it hasn't necessarily happened. I think that the decrease is flattening out a little bit, but it is still significant, and significant that we're below that baseline of 1.0. When you take a look on the next slide, this is demonstrating what we view as pricing relativity by the S&P sector and the index. So we're looking at the comparison of how each industry along the bottom there deviates from par, if you will. And you can see the financials are quite a bit more than a lot of other industries. Most of the sectors are below. Telecommunications probably almost spot on. Healthcare a little bit higher, and larger companies that comprise the S&P 500 will tend to be a little bit higher as well. Typically viewed as a little more risky. This is obviously average results and not differentiating between companies within the sector, which can have varying results, again, as you try to differentiate the strengths of your individual company. This slide shows the theoretical D&O capacity that I mentioned in the marketplace of over $1.2 billion. So there are lots of players, lots of competition, and that probably drives the pricing almost, more than anything, almost more than the frequency of the traditional securities class claims being down, because, as John mentioned, there are lots of other avenues for litigation that attack these policies, and I think M&A is an important one. And I would say we see almost nearly 100% of companies that engage in a transaction will have litigation. And that didn't used to be that complete, but it seems to be that way right now. So there's going to be a lot more litigation, but because of this capacity out there and a lot of the players willing to participate, especially in the excess layers, that helps keep the overall program down in terms of competition and capacity. What you will see on this is just basically what our clients have done as far as purchasing their limits, and this shows whether in each quarter the public company has increased or changed its total aggregate limits. And in quite a few of the quarters, you will see that they've, for instance, quarter 2, 2010, they took their savings essentially and reinvested it in additional limits. And when you can do that, this might be the time to obtain those additional limits, whether it's on the traditional program or whether it's on your Side A cover for non-indemnifiable losses, and you want to increase that program while you can get good pricing and get established with a carrier now for that. And as far as the relationships with the carriers, yeah, we believe they still matter. They are very important. And the underwriting meetings for your placement of your program can really, really assist an insured in differentiating the risk between others in the same industry, between others with the claims, to explain a situation or any news that an underwriter might typically look at to evaluate the risk. So we think those personal meetings are very important, especially because on the D&O program, remembering you're insuring the individual directors and officers. So it's actually pretty important for an underwriter to look at these people and be able to ask questions and make an evaluation, and we think that helps greatly in getting good terms and conditions and better pricing. And as far as the underwriting, the claims relationships really matter too, and we see this more and more as the pricing declines. The carriers are getting less for their risk. The terms broaden. There are fewer opportunities for them to exclude or cut off coverages for certain kinds of exposures. So it's really important to consider the claims handling abilities and experience of the carriers, not only in your primary layer, but into the excess layers as well, because you want someone who isn't just a commodity player, who isn't just coming there for a moment, and who will be there to understand the claim, to listen to you, to understand on any gray areas, and help where you might get the benefit of the doubt in a situation. So it's really important to have that relationship as well. And I think insurance don't do this enough. My world is a lot on the claims side, and I'm always happy when insurers consider that or ask about the people who are running their claims department and ask about how they handle it and what to expect in advance before they have the situation. So they're kind of ready, and those relationships are a little bit established, and you understand what to do to keep that relationship going so that you can have a positive claims experience. Really, the message is that communication is really essential to establishing and maintaining good relations with the carriers. That goes with both your underwriters and the claims personnel as well.
Hey, Jackie, this is John Landis. Can I ask a question going back up just to your issue about the underwriting meetings, and I know that you just said you're on the claim side, but as you're going through the process now with your clients, I mean, are you seeing any, trends that differentiate the current placement seasons versus the past? What the kinds of questions that underwriters are asking, or maybe just the kinds of questions that they're really focusing upon?
Mm-hmm. I think you'll get a lot of the same things. I mean, for public companies anyway, it's largely the underwriters are looking at your financials. And I will also say that underwriters vary from carrier to carrier as to their understanding of the industry. I think when you get the ones that ask insightful questions that go beyond what's in the public financials that they've purportedly read in front of them and ask about your industry trends or how you handle risk internally, how does your board operate, what is your exposure in international space, what are you doing to address that, what's the experience and the plan of the company going forward to all those kinds of things. It's not necessarily different than what has been in the past, so I think you'll get some better, we hope to guide people to that place where they'll ask those better questions. So I don't know that that's different, but maybe on the better underwriters you'll see more of that.
Any differences between the overseas carriers and the domestic carriers as the kind of things they're focusing on, or is everybody pretty much sort of on the same page as these days?
From the underwriting, and for the most part in the D&O world, while London market used to participate quite a bit, it's a lot less right now, and a lot of those traditional London market syndicates have actually, opened U.S. offices, so I'm seeing it, I would say it's almost more domestic oriented, in which case you don't really see differentiation. You will see Bermuda, I think, is really pretty much that they're participating largely on Side A part of the placements. But again, if you get the good underwriter who's going to listen and differentiate, you'll get some of that. Probably maybe they best less than some of the domestic ones who see a lot more of the U.S. business.
Okay, maybe I should just ask, remind me asking one more question. Let me just jump to Maria. Maria, I know you're on claim side as well, but your underwriting folks, are they, anything you can share with us that you can share with the audience about things that folks ought to be really, focusing on and drilling down on as they get ready for their meetings and as they're preparing applications?
Well, I think that our underwriters are probably better equipped to answer that. I mean, they're the ones who do it, but I do know that from what I can tell that they do, they really do detailed reviews of the company and really try and gain a really thorough understanding of what the company does and assets. So they do a pretty thorough review.
Is there anything, this question to both of you, is top two or three things or top one thing you would say, based on your experience, that companies can do to sort of differentiate themselves from other applicants to the same insurer? What kind of things, set you apart?
I think just the ability and willingness to communicate and being upfront with your situations. I mean, if everything's wonderful, that's one thing, but if you've got to address a situation, to be forthright and be able to address it, in the best way that you can, given any other restrictions you might have on what you can say. But I think if you're upfront about it, I think that's it's hard to put that across industry because there's different issues that hit different industries, but you got to be able to tackle that head on.
Okay.
Right. I would say that that's definitely very true. There's a very the transparency aspect I think is just very important.
Sorry to interrupt you there.
Oh, no, not at all.
Yeah, go ahead.
No, I think what I had left is some of the things that I'd already talked about, the pre-claim inquiry coverage and the personal protection suite, which is, again, part of that chart is offering from last year that another number of other carriers have also agreed to offer. It provides coverage for individuals for some, extradition coverages for when it was released, it was pre-Dodd-Frank, so it was talking about some expenses if there was a clawback situation that probably has to be expanded to address the Dodd-Frank issues now. And then, of course, the new SEC investigation entity coverage, and just that we've seen broad improvement just on the edges of terms and conditions. We get a lot of clauses or exclusions that are whittled away and become a little bit better, a little more improved on both the primary and the excess. And I would also say stay tuned for further developments and enhancements because this is a very dynamic marketplace, and that's something that always can happen. And so I think, Maria, then you've got some more comments on claim developments.
Thank you. I think that this past year has definitely signaled a return to normalcy with the credit crisis essentially calming down. We're seeing a slowdown in the financial sector claims, and the percentage of securities class actions in relation to total suits against companies have actually gone down, and they now represent about 16% of the total new filings. The new lawsuits that we've been seeing, they're still sort of heavily weighted as against the financial companies, but we're also seeing that they are evenly dispersed among other industries, healthcare, the for-profit, education, and information technology, just to name a few. We are seeing an uptick in the bump-up claims, and these are sort of breach of fiduciary duty claims. Essentially, they're typically brought by shareholders of an acquired company claiming that directors and officers accepted a lowball bid. When you look into the factors for this uptick, one would think that, well, there's a moderate rise in the mergers and acquisitions, and that may be the cause of it. But it appears that really the real driver of the uptick of these claims is the plaintiffs' attorneys and their recognition that there is additional revenue streams from these types of lawsuits. These cases have a very different dynamic than a typical securities class action suit and a much, much shorter life. Basically, you've got a at times you could have a multi-billion-dollar merger in place, and then you get this lawsuit, and there's a lot of pressure to settle this, for hundreds of thousands of dollars in plaintiffs' attorney's fees so that your multi-billion-dollar merger can go through. So it settles, it can settle as quickly in just a couple of months. But the pressures to settle this quickly for an attorney fee award just creates a very different dynamic for carriers also to try and get a handle on what's going on here. And we've been seeing a rise in a settlement. So what used to be only in sort of, hundreds of thousands are now in the seven figures. And it's sort of, not a very good trend. So as a result, basically these cases are settled pretty quickly so as not to hold up the merger, and then the plaintiff's counsel ends up making a pretty quick fee award. We think, as we're getting out of the recession, that we'll have more M&A activity, and that will probably then result in an even increased uptick in these types of claims. We're also seeing an uptick in enforcement matters. Since the credit crisis, regulatory authorities have stepped up enforcement efforts. They've beefed up their enforcement teams and began coordinating efforts with other governmental agencies. The SEC is definitely becoming more proactive and more aggressive, and it's definitely evidence in the claim activity that we're seeing. We're seeing not only sort of the high-profile, Goldman Sachs type claims, but private companies that do government contracts or just various different companies. At this early stage, it's kind of too soon to tell what these investigations are about, or they may not be at the formal investigation level. So it'll be interesting to see what develops in the next couple of years and what the SEC does with these. But we're definitely seeing an increase in those. the final part of the slide is waiting for the next big thing. I mean, that's sort of the million-dollar question. You know, I don't have the answer. I don't know what the next big thing is. You know, you can see trends, you know, FDIC litigations, upticks and bump-up claims or derivative suits, you know, but what makes sort of the big things that we've had in the past so problematic is that they've been so hard to predict. So I guess we're sort of watching out for it, but, you know, I have no idea what that next big thing can be.
Anybody want to wager a guess as to what it might be? I never know. I don't know. I do not know. Sorry, Maria, go ahead.
No. Next slide, please. The next slide really focuses on effective insurer relationships. I think it's important generally to keep in mind that insurers and insureds usually have interests that are aligned. You know, it's just really the effective, efficient defense and resolution of the litigation. You know, and as insurers, you know, we're very mindful of the big picture. How much we're spending on defense costs is, you know, is this a case that's really going to trial? Most often the question is not. And if the answer is no, you know, what's our resolution strategy? Controlling defense costs, I think, is essential. No one really benefits from out-of-control costs. You've got a depletion in available coverage that should be applied to dispose of the litigation, so that layers of coverage that should have been in play at a settlement table are actually eroded due to defense costs. I think that involvement of the carriers and the coverage counsel is crucial at mediation. As carriers, as an industry, you know, collectively, we're sort of sitting at the mediation tables of almost every securities class action lawsuit. We and our coverage counsel have, you know, developed rapport with the mediators, even plaintiffs' counsel. And I think that if we recognize that everyone's interests are aligned, you know, that the best results really are when, you know, the carriers and coverage counsel are allowed to work together with insureds and defense counsel to really bring about the most sort of effective and efficient resolution of the cases. And I think that pretty much is what I'm going to go over to Ethan Lenz for the rest of the presentation.
Thanks, Maria. I'm Ethan Lenz. I am a partner in Foley's Milwaukee office. I do a lot in the area of complex insurance coverage and risk management, in particular, negotiate a lot of D&O coverage and do some D&O claims-related handling. What I'm going to talk about today is really I wanted to hit on two areas at the end here and give you a little bit of a flavor of some of the issues that come up with respect to the terms and conditions in D&O policies, and then also give you a little bit of an overview of these areas because I think there's a lot of confusion and oftentimes misunderstanding on these issues in the area of particularly Side A coverage and how severability works under a D&O policy. And just stepping back, as Jackie had alluded to earlier, D&O policies are a different animal than a lot of your more standardized coverages. They're much different than a commercial general liability coverage or some of the other insurance coverages that your company might carry. And given that, they're non-standardized. Every D&O insurer writes their D&O policy on their own form, and therefore there's a lot of variation between the carriers in what is and is not contained in the policy. The other side of that is that the carriers are typically pretty willing to negotiate the terms and conditions. So at the end of the day, if you take the off-the-shelf form, the first offering that the carrier makes to you, you're not going to get the best D&O policy. The D&O policy is really, it's like any other commercial contract. It can be negotiated, and the more heavily you negotiate it from your side, typically the better deal you're going to cut with the D&O carrier. In terms of the coverage issues that I wanted to hit on, first of all, Side A coverage. Get a lot of questions from Side A, and usually what people are focused on, directors and officers particularly, is do I have Side A coverage and how much do I have? And I'm not sure that's always should be the end of the inquiry when it comes to what's in your Side A coverage. And stepping back, just so we make sure we're all on the same page, Side A coverage is what I call sort of your coverage of last resort as a director or officer. When everything else fails and you're sitting there facing a lawsuit, it is the coverage that is potentially going to kick in. And when I talk about everything else failing, what I'm really talking about is when indemnification from the company is not available for one reason or another. Usually, you get a suit against you in your capacity as a director or officer. Company is going to indemnify both your defense costs and the costs of any judgments or settlements. However, there's a couple of situations where indemnification might fail. And the most typical examples are, first of all, the statutory prohibition. And the area where that often comes into play is in the case of derivative actions. A number of states have prohibitions against a company reimbursing a director or officer for the costs of settlements or judgments that arise out of a derivative action. As John had said earlier, derivative actions are one of the areas where you're starting to see a lot more play from the plaintiff's bar. And given that, Side A coverage becomes potentially much more advantageous to a director or officer. Other area where you often see indemnification failure is in the bankruptcy setting. Company's broke, it can't live up to its indemnification obligations any longer, but there still might be suits out there against you as an individual director or officer that are not barred by the bankruptcy proceeding. You still may be incurring costs, and Side A coverage is what is going to cover you so you don't have to dig into your own pocket. Another key part of Side A coverage is typically it will not have any retention or deductible applicable to it. The whole point of Side A is and should be that you as a director and officer are fully protected when the indemnification fails. You don't have to dig into your pocket in order to pay the cost of a claim that's outstanding against you that the company can't indemnify. Now, with that said, there's a couple of places where Side A coverage usually shows up, particularly if you're a director or officer of a publicly traded company. Usually, a publicly traded company, at least, will have two forms of coverage, or I should say, maybe not usually, but oftentimes. The first is a primary tower of coverage, where you have what everybody calls Side A, B, and C coverage. Side A coverage, again, non-indemnified claims. Your Side B coverage is coverage for the company when it indemnifies you as a director or officer. The thing with Side B coverage is that typically there is a hefty retention on it, and also the way it works is that the company indemnifies you as a director or officer for the cost of the suit, cost of any settlements or judgments, and then turns around to the insurance carrier and gets reimbursed. Side C coverage, that's the entity coverage. If the entity is also sued, and if you're a publicly traded company, it'll only be for securities actions. If the entity is also sued as part of a lawsuit, Side C coverage kicks in. What this creates with respect to your Side A coverage is a potential issue of you as an individual director and officer are sharing the limits of your Side A coverage with both the Side B and Side C coverage. Usually there's one aggregate limit of liability on a D&O policy. You don't get separate limits for each of the A, B, and C coverage. So if the B and C coverage take down the limits of the program, you can be left without any further Side A coverage. That's where potentially the existence of a separate Side A tower of coverage, which many companies are now buying, comes into play. What you're dealing with there with a separate tower of coverage is you have dedicated limits as an individual director and officer for the Side A coverage only, not sharing it with the company in any way, shape, or form typically. And the advantage of that is, of course, that if you get into a situation where indemnification isn't allowed, you have your own separate limits for that. Some of the other advantages of having a separate Side A tower are typically the coverage is a little broader and has limited exclusions. You might get rid of things like the insured versus insured exclusion of the policy. You might have a more limited ERISA exclusion. So the Side A coverage might actually, and typically is, be broader. It will be broader than the underlying A, B, and C coverage. So it's often looked at as a somewhat better coverage in that respect. Also, the Side A coverage is usually fully non-rescindable. Once the insurance carrier issues it, they can't rescind the policy and take it away because of alleged misrepresentations in the applications or other things of that nature. So, stepping back with your Side A coverage, the question really shouldn't be, do I have Side A coverage and how much do I have? You should take the inquiry further. It should really be, how much Side A do I have, and how is the coverage actually set up? Am I sharing my limits? Do I have separate Side A coverage that's only for me? And if I do have separate Side A coverage that is only for me and my fellow officers and directors, how does that coverage differ from the underlying? Is it actually broader? Will it fill in the gaps of the underlying insurance in some cases? So there are a number of questions you should be asking in addition to, do I just have Side A and how much? Second area I wanted to hit on is severability issues in a D&O policy. And what I'm talking about here is the situation where you have the so-called white hats and the black hats. You've got one group of officers and directors who are innocent, have not done anything wrong, and you've got another set of directors and officers who have engaged in or allegedly engaged in some type of fraud or other really bad activity. And the issue becomes, well, what happens? Do I, as a white hat, lose my coverage or somehow have more limited coverage because one of my fellow directors or officers engaged in fraud? Can I somehow lose my coverage based on what somebody else did? There's two areas where severability comes into play. First one is in the exclusions of the insurance policy, of the D&O insurance policy. And give you an example of that. Every D&O policy has an exclusion for claims based on fraud or claims based on the making of illegal profits. And there should always be in your D&O policy a provision that says if one director or officer has engaged in fraud or has received illegal profits, they are treated separately from the innocent officers and directors. Innocent officers and directors don't lose their coverage because another officer or director has engaged in fraud. That should be minimum severability on your exclusions. The sort of gold standard is you have severability on all the exclusions. So if an exclusion applies to one director or officer because of something he or she did, it doesn't knock out coverage for you if you weren't engaged in the activity that triggered the exclusion. So the gold standard, again, you want to have full severability of all the exclusions if you can get it. Other area where severability comes into play is with respect to application misrepresentations. And what you're dealing with here is you fill out an application for the D&O policy. There are certain questions that have to be answered in that application. Typically, it's signed by the CEO and CFO. If you're a publicly traded company, your financials are going to be attached to that application. If there are misrepresentations or those financials end up being misstated down the road, it can be construed as an application misrepresentation and potentially impact the coverage for the directors and officers. Now, the traditional way that D&O insurers handled application misrepresentations was purely with what I call the death penalty, policy rescission. If there was a misrepresentation in the application, they could rescind the policy, make it go away as if it never existed. So the issue becomes, well, who has their coverage rescinded? And policies are written in many different ways in this respect. There are policies that are written where you don't see it much anymore, but there are some policies out there where there's no severability. If there's any misrepresentation in the application, everybody loses their coverage. The way many policies are written is that if there's a misrepresentation in the application, only those officers and directors who knew there was a misrepresentation lose their coverage. That's severability. It severs off the innocent directors and officers from the black hats who knew about the misrepresentations. Now, one of the things I see kicked around a lot within the last couple of years is people coming to me and saying, hey, we got a great deal. Our policy is non-rescindable. And my reaction to that, after looking at several of these policies, is to typically say, all right, you've avoided the death penalty under the policy. Let's make sure you're not still going to have a near-death experience. Because what happens with these policies is that insurers will sell them as non-rescindable policies. Great. They can't ever take them away from anybody. You can lie, cheat, and steal all you want to in the application. But what ends up happening is those same policies that are non-rescindable will have another provision in them that says, if there's a misstatement in the application, we won't take your policy away in full, but we won't cover any claims that are based on the misstatement that was in the application. What's that mean? Particularly if you're a publicly traded company, what it means is most of your claims, at least your big shareholder class actions, are going to be based on alleged misstatements in your financials. Your financials are attached to the application, and since they're attached to the application, they are a basis for making the claim that there is no coverage under the policy for the particular claim because it is based on a misstatement in the application, that is, in your financials. So you end up losing your coverage for the claim. You still got the policy there, but the biggest claim that's sitting facing you is still not covered. So it becomes very important if there is that type of a claim exclusion in the policy, even though your policy is non-rescindable, you still got this claim exclusion, you need to have severability there as well so that a misrepresentation in the application only precludes coverage for that particular claim for the officer or directors that knew about the actual misstatement, not for all the white hats who innocently are going to be affected by that misstatement in the financials. All right, and with that, we're going to open it up to questions and answers. And
Ethan, this is Jessie. I think that we received a few questions, but we're not going to have time to take care of those on this call. So we will get to the folks who ask questions individually after the conference via email. So thank you for presenting those questions. And thank you, Ethan, John, Jackie, and Maria, for the excellent insights and practical takeaways to keep in mind for the upcoming 2011 board meetings. We hope all of you enjoyed today's presentation. We ask that you please take 30 seconds to participate in our brief online survey at the conclusion of this call. These surveys are very helpful to us in ensuring that our NDI programs are providing you with practical advice and recommendations and to help us develop ideas for future NDI topics. So once again, thank you for attending our NDI, and we'll talk to you next on April 20th as we address investment committee responsibilities. And thanks again to our panelists.
Ladies and gentlemen, this concludes today's conference. Thank you for your participation and have a wonderful day.